I'm sorry to start this year on a bearish note, but I think we have to look the truth in the eyes. I think another global financial crisis, GFC number 2, is currently in the making. And the reason for this is the heightened inflation rate and with it the ever increasing interest rates. Now, this is no new news, right? But there is hope that the inflation rate is going down and that monetary tightening will stop. How realistic is that hope? Is this really going to happen? In this video, I want to look at a few charts, of course, the inflation rates, but also I want to look at housing, I want to look at oil reserves, and basically paint a picture what's actually going on at the moment. What we see over here is the true inflation rate. So this is not the official inflation rates, it's day-to-day calculated inflation rates based on new data that's fed into the basket, right? The inflation rate is calculated based on a basket, and there's several constituents of that basket: housing, food, transport, etc. And currently the inflation rate for the US is at 5.74% according to this index. Now, it's good that this inflation rate is going down, but it's still nowhere near the target of 2%, right? The Fed is targeting 2% inflation rate. Unless we haven't met this, or unless we don't anticipate this to stabilize around this level, the monetary tightening is likely going to increase, right? Borrowing will continue to become more and more expensive, and with it all the knock-on effects on housing, etc. So it's good that it's coming down. But first of all, why is this coming down and how does this actually look globally? When we look at the UK, we see a very interesting difference here, a very stark difference. The UK has a rising true inflation rate, a rising inflation rate at more than 20% per annum. So why aren't these inflation rates correlated that much? We've seen pretty similar stimulus across the board, right, in the US and in the UK and basically globally. Why is the UK behaving so drastically different in terms of inflation? Now, when we look at the US, what we notice is that the main driver for this decline in the inflation rate is transport. The transport prices went down massively, right? The inflation rate of the transport prices currently at the target even, right? At 1.9%, coming down all the way from 23.4%. So a very steady decline, and this is in the end what causes this overall decline. Now, we don't have this effect in the UK, right? The energy crisis in the UK continues because of the Russia-Ukraine war. Now, how stable is this decline? Are we going to see further decline in the inflation rate in the US? Why is the transport price going down that much? I think it has mainly something to do with the oil reserves being used in the US. So look at this. This is according to Wikipedia. It's recently updated. The US strategic petroleum reserves. And we see how massively they actually went down, right? From over 700 million, so 714 million barrels in 2008, all the way to today, right? Basically being cut in half, less than 400 million barrels. And we see this pretty drastic decline in 2022. So the US is basically using up its oil reserves in order to stabilize inflation, in order not to push up all these transport prices, right? That's what's happening in the US, and other countries don't have these reserves, or they have to even import, say, natural gas from the US, etc. And this pushes up the inflation rates across Europe way, way higher than what we see in the US. Now, how is this likely going to continue? We've already used up half of those reserves, so that's not so great. But are we going to continue using those reserves until we maybe are at these 2%, right? Because if we are at the 2% inflation rate, then monetary tightening will probably stop. The problem is the plan from the US is to actually stock up the oil reserves again. So after oil price declines during the second half of the year, in December, the US administration announced it would begin replenishing the oil reserves in early 2023, expecting to purchase oil at lower price than it was sold, a process that would take months or years to complete, but still there will be likely going to be a net increase in the reserves again, or in other words, I think it's likely that the transport prices are not going to further decline anymore. Now, we don't have any selling of oil anymore, and so the inflation rate, in my opinion, is likely to increase again, right? So that's the problem. It's probably not going to reach a similar level to the UK with 20%, but it's also probably not likely going to go down, continue to fall to the 2%. Now, why is all of this happening, right? We've seen the COVID stimulus across everywhere. We've seen the stimulus programs. What's the driver of this inflation rate? Why are we now consistently above the 2% when it was so stable for like decades before? The reason, in my opinion, is the starting or the further manifestation, further growing of the deglobalization. So we used to push down inflation rates a lot by manufacturing quite a bit in China and by importing cheap energy. This is now stopping, right? We've got all the trade tariffs with China, less and less trade with China is happening. We also had all the COVID restrictions that clamped down on a lot of globalization. There wasn't a lot of movement of people happening. At the same time, we also have the elevated energy prices from the Ukraine war. Now, those effects can potentially reduce, right? So let's say, because now China is opening up somewhat, right? There's now all this infection going on within China, but China is going away from the zero COVID policy, right? This would mean that potentially trade could start again. And the same is true for the Ukraine war, right? Maybe at some point, the maximum investment that the US wants to put into this war has kind of like peaked, and this would then result in probably some kind of peace negotiation. So this would be the potential upside. The issue I see is that still the relationship between the countries is probably more or less irreversibly damaged from this. So even though the conflict, the Ukraine conflict, might stop, this doesn't mean that suddenly Europe and Germany, for example, is going to massively import gas from Russia again, right? Because you don't want to be that dependent on Russia when there's now all this risk, because maybe Russia might start another war at some point in time because they don't feel safe with the NATO expansion. Same is true for the China conflict, right? Even though COVID is now more or less coming to an end in China as well, the COVID restrictions, doesn't mean that this will now magically resolve all the trade problems, right? This already happened before COVID. So I think we are going to continue to see a bipolar kind of world. We are going to continue to see the West versus the East, and we are going to continue to see a decline in the trade between those two parts of the world, which then in turn means more goods and services have to be produced domestically, which then in turn means prices go up, which then in turn means inflation rates don't come down to 2%, which then in turn means that interest rates are likely going to continue to rise. Now, what does this all have to do with a global financial crisis, right? Just because interest rate rises doesn't necessarily mean we will see a big crisis. The issue is, in my opinion, that a lot of the pressure that's currently in the system has not yet materialized in prices. And what kind of market has the most pressure from rising interest rates? It's the property market, right? Because most of properties are bought on mortgage, on debt. So when we look here at the Federal Housing Finance Agency, the recent report that came out in December of this year, so just or December of last year, we're already now in 2023, right? But just a few days old. It goes through all the data through October of 2022. So we do have a bit of a lag here. But when we look at this, right, this was the global financial crisis, right, where property prices went down quite a bit by like 30-40% probably. And then in 2011, we saw the recovery. And now we are at all-time highs, right? This is the property housing price index. And this is now the little blip that we see. So the growth has stopped and is now coming down slightly. So if you look at a bit newer data, if you try to look at indicators that are forward-looking, this is already coming down a little bit. But still, we are at a very, very elevated level. And that's a bit of the problem, right? Housing affordability is really plummeting. The demand is going down. But at the same time, we don't yet see a lot of forced selling because people still have savings. But if this continues for long enough, because inflation rates don't come down, and if interest rates continue to rise, the pressure in the property market is likely going to increase further and further and further, which then would lead to a collapse maybe similar to the global financial crisis, right? We might just relive something like this. And who knows what then actually breaks, right? Will it be the collateral from the banks that then the banks have to shut down and have to be propped up? Will it be something else? Nobody really knows where the weakest link in this whole chain is. But something at some point will break if we're not going to come down in inflation, if we are going to increase in rates. And then the big question is what's actually going to happen when something major is breaking. Let's say we really see just a revival of what happened in 2008, right? 2007, 2008. Let's say the whole thing just plays out the exact same way, which is unlikely. But let's say the banks have to be propped up again. Will interest rates then still continue to rise, even though the inflation rates are not at 2%? I don't think so. I don't think interest rates will continue to rise. I think we will see some kind of an emergency stop. We're seeing a recession probably at that point, right? Profits are going down. We see all the collateral losing in value. We see the property prices coming down. And then the inflation rate might be kind of the least important of the political issues. If nobody is employed anymore, if everybody is becoming poor, then what does it really matter if the price, if the fiat money devalues by 5% or by 2%? So there's basically, in my opinion, two potential outcomes here. The first one is that we're simply going to rise the interest rates further and further until we see really a global financial crisis again. The second potential outcome would be that this is anticipated to a certain degree, that we don't let everything crashing down completely, and that the Fed will simply just revise their inflation target. So what could also happen, not saying this will happen, right? But one scenario is instead of making all of these systems implode, what could happen is, okay, we just say our new target inflation rate is 5%. Because now the economy is already becoming less and less global. We are kind of expecting prices to rise. Let's just keep it now at 5%, and that's end of the story. This is maybe the most likely scenario. We have been at this 2% level for a really, really long time, but I'm not sure how strong the Fed is really going to be if everything else around them is burning and if only the money is somewhat stable. So this is why maybe the title of this video is a bit clickbaity, but still, we are currently on a trajectory that's very, very dangerous. We are on a trajectory where the property market hasn't yet adjusted, where the pressure at the property market is increasing and increasing, where inflation pressure is increasing because reserves are not being sold off anymore. And so we're probably going to see the same thing that we have seen at the end of 2022. We'll probably see the same thing in Q1 and Q2 of 2023. So that's at least how I currently see the whole dynamics evolving. And we have to see some kind of a major event that shifts this around. Because if we just simply continue going the way we're currently going, it's likely, the inflation rate is likely not going to bottom at the 2%, right? There's simply too much outside pressure. And we already see way more pressure in other countries, and they are also very, very far away from the 2%. The UK and Europe in general might be even the first part of the world that's going to completely abolish this 2% target, because it's just very unrealistic, right? You can't raise interest rates so high to crush the economy to that degree to get back to 2% when energy prices are that bad. Yeah, hope this was useful. Looking forward also to your thoughts in the comments. Don't forget to give this a thumbs up. It will help the algorithm. The channel is still small. I very much like the subscriber numbers increasing, of course. So any support is appreciated. We've also got a Telegram group in the description. Feel free to check that out. So see you in the next video, and thanks for watching. Bye-bye.